Welcome to the TAC Index AI podcast, November 6, 2025, where we blend TAC IP data, reports, and charts with the latest news in all things logistics with a focus on air cargo.
And today our mission really is to pull out the key insights from that TAC index data. We want to understand how these air cargo rates are bumping up against some pretty big macro drivers.
Right, things like trade policy, energy cost, see how it all ties together for global logistics and maybe the wider economy.
Exactly.
So let's jump right in. The headline data, the Global Baltic Air Freight Index, BAI 0, it's up again, third week running.
Yep. A solid 2.4% gain week over week. It definitely feels like we're heading properly into that traditional peak season now.
Okay, so where's the heat coming from, geographically speaking?
Well, what really jumps out is the strength coming out of Asia, particularly on those trans-Pacific lanes.
Okay.
Shanghai, the BAI 80 index, saw a really punchy gain, 7.1% just week on week.
Wow, 7.1%. So shippers are moving quickly then.
Seems like it. Trying to get ahead of that holiday rush, locking in capacity while they still can, perhaps?
But it wasn't just Asia, right? I saw a big number out of Europe, too. Frankfurt.
Oh, yeah, Frankfurt, the BAI 20, that surged 10.7% week over week. Quite dramatic.
Over 10%. What's behind such a massive spike there? That actually pushes Frankfurt back into positive territory year over year, doesn't it?
It does, just barely, plus 1.3% year over year now. That 10.7% weekly jump, it suggests, a pretty sharp correction. Maybe capacity got tight quickly. And remember, the transatlantic routes from Europe to the U.S., they're doing really well.
Oh, okay.
We're seeing gains like approaching 25% year over year on some of those. So demand for European goods in the U.S., it still looks pretty robust.
Interesting contrast, though, because what about the other way? U.S. outbound?
Right. That's where the picture gets complicated. Outbound U.S., if you look at Chicago, the BAI 50, that actually fell 5.9% last week.
Fell nearly 6%.
Yeah, and it hit its lowest level in several years. So a real divergence there.
Okay, hold on. U.S. outbound hits a multi-year low, but imports from Europe are surging maybe 25% year over year. What does that tell us? Is that a warning sign for the U.S. domestic economy?
Well, it could suggest a couple of things. First, maybe U.S. outbound capacity is just, more available because demand for U.S. exports is a bit softer right now.
Right.
Second, it really highlights that global trade routes are shifting. Things are being restructured. And that's actually why TAC Index is rolling out coverage for, I think, over 20 new lanes.
Oh, interesting. Like where?
Places like Taiwan to Europe and the U.S., Mexico to Europe, lanes that are becoming more important. It shows there's huge demand for visibility on these changing patterns.
And that need for visibility, that leads us nicely into risk management, right?
Yeah.
It's becoming so crucial.
Precisely. For the big players, the historical lack of, let's say, reliable pricing data in air cargo has always been tricky.
But opaque.
Very opaque. But now, these daily BAI spot indices, the ones covering key routes out of Hong Kong, India, Korea, they've achieved FCA compliance.
FCA-compliant. Okay. What does that mean practically for, say, a forwarder or a bank?
It means real transparency. For you listening, it means these indices can be used as trusted, verifiable benchmarks. Banks, carriers, big shippers, they can confidently use them for hedging their contracts, for settling index-linked deals.
So it brings a kind of financial market standardization.
Exactly. To air freight, something that was really only possible before in major commodity markets. It helps manage risk in a volatile sector.
Speaking of volatility, let's shift gears to a major cost driver. Fuel, jet fuel specifically. We see U.S. crude around $60 a barrel. Seems kind of stable on the surface.
Yeah, on the surface maybe. But the context is pretty concerning. The U.S. Strategic Petroleum Reserve, that big federal oil buffer, it's at its lowest level in about 40 years. 40.
Wow. Lowest in decades.
And at the same time, geopolitical risk is, it's high. You've got sanctions affecting Iran, Venezuela, Russia. That's something like 15% of global oil output potentially constrained.
So the current $60 price is almost misleading.
Yeah. It's potentially an illusion of calm. It seems like a golden opportunity to refill that SPR buffer, but replenishment is incredibly slow. Needs something like $22.5 billion, and there are budget constraints.
So any shock.
Any geopolitical flare-up could send jet fuel prices spiking almost immediately. That hits carrier costs hard and could push freight rates up even more, regardless of demand. It's a real risk hanging over the market. Okay,
so cost volatility from fuel is one major uncertainty. What about policy? I saw China suspended some retaliatory tariffs.
They did on some U.S. farm goods effective November 10th. A bit of a positive signal,
But
perhaps.
there's always a but, isn't there?
Well, yeah. The crucial detail is that U.S. soybeans, which are a huge cargo item, still face a 13% tariff.
Ah,
So for commercial buyers in China, Brazilian soybeans are likely still the cheaper option. It helps a bit, but doesn't fully normalize that trade flow.
right. But the really big policy wildcard, the potentially massive one, is the U.S. Supreme Court case.
Absolutely. This is the one everyone in global logistics should be watching very closely. The court is questioning the legality of those global tariffs President Trump imposed.
The ones under the IEPA, that Emergency Powers Act.
Exactly. A 1977 law meant for genuine national emergencies. And the court is looking at it through the lens of the major questions doctrine.
Okay, major questions doctrine. Can you break that down simply for us?
In essence, the court is saying, look, if a government agency, or in this case, the president via the executive branch, makes a decision that has huge economic or political consequences.
Like imposing tariffs on trillions of dollars of trade.
Precisely. Then Congress must have very clearly given them the authority to do that specific thing. The law needs to be explicit.
And if the court decides Congress wasn't explicit enough back in 1977 for these kinds of tariffs?
Then potentially trillions of dollars worth of tariffs could be struck down, not phased out, struck down immediately.
The disruption would be instant. Global supply chains, pricing for air, for sea, everything changes overnight.
Everything. The economic calculation for sourcing, shipping, everything gets redefined on the spot.
Okay, so let's try and pull this all together. Our deep dive shows air cargo rates are definitely rising into peak season. Strong out of Asia, strong out of Europe.
Yeah, and we have these new market transparency tools like the FCA-compliance, bringing some much-needed structure for risk management.
All of that is happening against a backdrop of, well, serious instability. High geopolitical risk-making oil prices, a potential time bomb, and this looming Supreme Court decision that could just rewrite U.S. trade policy in a single day.
Exactly. Which brings us to the final thought, the provocative question, maybe, for you listening.
Go for it.
Okay, so the air freight market seems to be pricing in a pretty strong peak season right now. Rates are climbing. But at the very same time, the highest court in the U.S. is debating whether key tariffs underpinning current trade flows are even legal. So what happens to global rates, to supply chain planning, to everything, if trillions of dollars in those duties just disappear overnight? That's the huge question mark hanging over logistics right now.